Welcome to this ODA Grain Market Outlook. My name is Gary Phillips. I'm Country Manager of ODA, and I will open this meeting. However, our principal speaker today is Sébastien Mallet, Managing Director of ODA. Sébastien is a former grain and oilseed trader in Argentina, Ukraine, and Europe. So don't hesitate to ask him any questions at the end of this session. Any questions we've not had time to cover today can easily be addressed by email later. We aim today to answer the question most farmers are asking: will grain prices remain strong in 2021-22? We'll focus on both our domestic market as well as the international perspective. The format of this event will be a formal presentation interspersed with questions and answer sessions. We will pause twice during this presentation to address the questions you have raised already. Furthermore, we encourage you to raise your written questions throughout the presentation. You can easily type your questions into the section at the bottom of your screen, and we will intend to address all of them at the end of Sébastien's paper. Introductions and process addressed, we now begin. Sébastien, next slide, please. Let's start with a very brief description of who we are. We're a UK-based independent grain marketing consultancy. What do we do? Our role: providing and delivering training, information, and advice for combinable crop producers here in the UK and across Europe. In the UK, we deliver our services to clients from Cardiff to Beccles and from Southampton to the borders and all points in between. Overall, providing price risk management advice to a community of growers in the UK and across Europe. Sébastien, over to you.
Thank you very much, Gary. And hello to everyone. So we're going today to take you through the latest market information we get and try to forecast a little bit what we foresee for the coming months. The market information has been very rich lately, and the markets have been very volatile, which makes our work even more interesting. So we will focus first on the UK market and try to explain why and how the markets went up so strongly. We'll go through the world markets later on in the presentation, and then try to foresee what are the key influencers and what strategy a UK farmer can put in place to address this very strong volatility. So moving to the first slides. We are going to explain here why UK prices are so strong. So there are three factors for that to explain the above £200 level. The first one that you can see on this screen is the spread between the UK market and the continental market, and we use as a benchmark the MATIF. So this is the spread between the live market and the MATIF market. So as you can see on this screen, and if you remember well, in October, November 2019, when you were drilling your crops, you had a very adverse conditions. You could not get into your field, and as such, the market started to worry about the ability of farmers to drill adequate area in the UK. And as such, the spread went from minus £20 to today around +8, +10 So this is a nearly 30 quid price increase just because the UK market or the UK production would not be sufficient to address the UK domestic market needs. So in fact, what this graph illustrates is that when the UK is a net exporter, the prices have to be cheap enough to buy some market shares into the export markets. And when the UK is a net importer, like we had this year, the price has to increase enough when compared to the world price to be able to attract imports. So this year, around 2 million tons of imports have been needed to balance our needs in the UK. And as such, the UK market is trading at a premium to the world market. So this is a nearly £25 premium into your domestic price, just because the UK, being an island, needs to import from abroad to balance the domestic needs. A second UK, pure UK situation is, of course, the currency. So since 2016, when the Brexit election took place, referendum took place, the sterling went down from, let's say, 0.70 to 0.90 level, and this has led also to a 20 to 25 pounds premium to your UK wheat prices, and this is purely linked to the currency. So we can see here on this graph that since the soft Brexit was agreed with Europe, the currency tends to go down. It's about 0.86 today, and we expect it to very quickly now go to 0.85, which is more or less 5 to 6% higher than what it was before January. Sorry, and we will see later on in the session that we can expect maybe this sterling level to increase further. And the last but not least reason for the UK prices to be high is, of course, the international situation. So on these three graphs, you can see the reference market for the world market, which is Chicago, and this is the corn, the wheat, and the soya prices. And I think it's very interesting to look at the history of the prices to predict the futures. So I think we can highlight 5 elements on this graph. First of all, is that all the three major crops are very correlated. When one is going up, the other one is going up in the history. The second one is that the market seems to have phases of volatility. So if we look here, we've got 7 years of very low volatility, followed by 7 years of very high volatility, followed by 7 years of very low volatility. This is the past 7 years. And we seem to be entering again into a high volatility period, which could maybe last a few years. So we might be entering now into a 3, 4, 5, 6, maybe 7 years of more volatile prices. Another element to highlight is, of course, that when prices go up very quickly, like they are doing now on the corn and the soya, they can also decrease very quickly. We can see that in the past history too. The fourth element is that, and it's quite easy to see that on these graphs, it's the corn and the soya market that have led the current high price situation, wheat being much more a follower, and we will see later on in the situation the reason why. And last but not least, if we look at all these graphs, we can see that historically, if the situation doesn't improve in terms of supplies in the world during the spring, or if we have other risk on the production, there is much more room for prices to move higher. So we will detail all that in the coming presentation. But first, let's take a look at the latest trade data in the UK, and we will move to the international situation later on. So latest trade data. This is a graph representing the monthly imports of wheat this year. So we can see that the imports have been very strong, and the latest data we have is in December. So that was just before the Brexit took place. Soft Brexit took place. So we can easily understand that importers made a very big job to have as much wheat into the country before the Brexit would have been decided. It's easy to understand that looking at this graph, that most of the job has been done by the market, and the UK, to balance its domestic demand now, only needs 130,000 tons of monthly import to meet with the DIFRA needs of 2.2 million tons. So this, let's say that during the first 6 months of the season, the market has done its job, and the UK should very safely now be able to meet with the domestic demand. On the corn, we can also see on these yellow bars that the corn imports have been record this year. That was to compensate, of course, part of the lack of feed wheat in the UK. But this trend, this import trend, seems to be decreasing now, and this is very easily explained by the much higher corn prices and the lack of availabilities in the world for the corn. So we can expect these corn imports to quite drastically decrease in the coming months. So the consequence for you farmers is first of all, these very large imports might impact in the second part of the season your quality wheat premiums, and we've already seen the Group 1 premiums going down, and they seem to be going down quite drastically now, as a large portion of this imported wheat is German wheat, and German wheat is of a high quality wheat. But the feed base price should not be very much impacted yet. A second thing, I'm going to move quite a bit faster because I'm conscious about time and we have quite a lot of slides to go through. But as you might have heard in the press, there seemed to be the start of a crisis in the feed industry, with feed prices and feed production going down. So this is partially due to a post-Brexit issue with a lot of bureaucracy to export the pigs out of the country, and it looks like it is much easier for Danish and German to export it into the country. So as a result, the price and the volumes are going down in the UK, and that might again impact the feed demand, which was record up to now. The feed demand, we reckon, might go down in the second half of the season. So that might also impact partially the wheat prices in the UK. Another element, very important element this year, is like a bit like we had in 2019. Most of farmers, not all over the country, but most of the farmers have faced very adverse conditions, again, because of very wet weather. So this is leading the new crop, big questions about the new crop wheat potential. So we had done a survey wheat survey back in November, where we valued the wheat production at 14.2 to 14.5 million tons, which was a pretty comfortable production level. But given the fact that December and Jan have been very wet, most of the farmers we know and we discuss with haven't been able to drill what they wanted to drill, because now in the UK we drill winter wheat up to the end of February. So there is a real question mark now on the ability for UK farmers to drill what their initial intentions were. So this has led, we come back to this live matif spread. This has led the market to consider that there was a major risk for the UK to again be a net importer next year. And the spread between live and matif has gone from -15 to around -3 now. So this is clearly supportive for the UK prices, but we can consider that right at the moment at -3, we are sitting in the middle of the bridge, and the market is now expecting for the spring conditions. So the wheat, the spring wheat area that will be drilled, and also the spring conditions for the winter wheat that is already in the ground. So because we remember last year we had a very dry spring condition, which has further impacted your yields. As such, we are really sitting in the middle of the bridge now, and clearly, I would say in March or April, once we will have a better view on the situation, the market will decide whether we consider the UK will be a net importer. In that case, we could increase by another £10 when compared to the European price. Or if we consider the situation has improved and we could move to a higher than 14 million tons production in the UK, the market will decrease to a minus 15 spread, minus £15 spread. So this is to tell you that in the current price level, which is around 169, 168 for the new crop, you could add £10 if the production in the UK is between 13 and 13.5 million tons. But if the market, if the production is above 14 million tons, you could quite easily lose £10 on your prices. That's about it for the first part, which is focused on the UK. Gary, would you have any questions from the audience, or
Thanks,
shall I?
Sébastien. We've got some questions here to address straight away.
Yeah.
In the first instance, one question that's come in regarding old crop. Do we see the old crop cereals and oilseed rape continuing to rise until the 21 harvest?
Okay. So I will, of course, address this question all along this, and I think, Gary, this will be part of my conclusion. So I would prefer to address this question maybe later on, because it's not only a UK. It's not only the UK situation that is going to drive prices up or down, but just very quickly, I have highlighted here 2 or 3 risks. One is, of course, the sterling, with the possibility to get to 0.85 and maybe to 0.80. And for the moment, the major factor that impacts the currency is the vaccines, because England is doing very well on the vaccine side, and you might well be very soon the first country to have, let's say, beaten the virus, and that is considered as pretty bullish for the sterling, and thus bearish for the oil crop prices. So I think, yes, I see a risk there. I see also a risk in the fact that the UK has imported more wheat than we had expected. So we'll see in Jan or Feb if this trend continues, and that might pressure a little bit the domestic prices. But otherwise, looking at world prices, and I will develop that afterwards, our view is clearly still bullish. So it's a balance between the two.
Thank you. There was another question that came through regarding the emphasis that you've placed upon whether the UK is an exporter or an importer. When do you think ODA will have a better idea about the UK new crop potential?
Yeah, no, that's very important. Thank you, Gary, for asking that. Yes, that's a very important thing. So in ODA, in the UK at least, we tend to focus very much into that subject, because as you've seen in this presentation, there is 30 quid easy made if we manage to anticipate well the fact that the UK is going to be a net importer or net exporter. So we did already make a crop survey in November. We will do another one by the end of March, beginning of April, with as many farmers as we can and all over the country. That will allow us to have a much better view on the production potential. So if we land to a 13.5 million tons, I think the spread will remain where it is. If we have risk to get a production below 13 million tons, we will certainly anticipate higher prices for the new crop.
Thank you, Sébastien. The other questions we have, we can move them into another part of the paper. Please carry on.
Okay. So why are world prices so high now? We're going to make a bit of history of what has been going on during this season, and try to foresee where we stand now and what could be the future. So that's I already mentioned that before, but that's a very important element to take into account for us and for you farmers, is that we might very well be entering into a long period now of high volatility. So that makes our job much more interesting. That makes the farmers' job maybe a little bit more risky, because when we talk about volatility, we talk about prices going up and down. But for farmers who are tooled and maybe well informed, it clearly creates an environment of opportunities. So be prepared for a pretty strong volatility in 2021-22, and quite certainly into 2023 too. So the major reason why the prices went up this year is that the three major crops, corn, soybeans, and wheat, ending stocks all went down at the same time. So this is very rare in our market history. Usually we have maybe the wheat going down, but the soya going up, etc. So this is very rare, and since 2000. I think it's the first time for the last 10 years that we have a combination of the three major crops ending stocks going down. So we'll try now to understand what happened. So as you know, and even if we are focusing on this presentation very much on the wheat market, we will see on this slide and on the coming slides that it is not necessarily the wheat market or the wheat fundamentals that have led to very high prices. So the story really started with the corn and the soya situation in the US. So this is a pretty interesting chart on the top left. These are the USDA monthly ending stocks figures that they release every month. So back in September 2020, the USDA was predicting a 64 million tons ending stocks for the corn. Everyone was forecasting a huge production, pretty low exports, pretty low ethanol usage because of COVID, etc., etc. And month after month, these ending stocks nearly divided by two. We went from 64. We are now at 38 million tons, and in ODA we even believe we should be below 35 million tons. So this is due to two major factors. One is a lower area harvested, slightly lower yields, but most of this decrease, and we will see that further on in the presentation, is linked to Chinese demand. A similar situation, so as you can see, as the USDA was lowering the US ending stocks, the corn market nearly doubled during this period. The soya situation is facing a similar situation. The ending stocks went down from 12 million tons to 3 million tons. And just for your information, 3 million tons represent roughly 2 weeks of Chinese demand. China imports about 8 million tons per month. So this is a very, very, very low ending stock level. And similarly, the prices went up as the ending stocks were going down. So this is also partially due to a lower production, lower yields, lower area harvested, and of course also higher demand from China. So the stocks are low. We know that, it's a fact. But now if we make a bit of history of last season, it all started with the European wheat production that we knew as soon as March, April, May, throughout June. We knew that that Europe, including the UK, would have a disastrous production. We knew that from quite a long time before, because the area was lower. France, exactly like England, had great difficulties to enter the fields during the autumn. So we knew the yields were going to be lower, and as such, Europe, including the UK, harvested about 18 million tons lower production than 2019. So we consider that as bullish for wheat, but we knew also at this time, or that's at least what the market was thinking, and ODA was including in this thinking. We thought that not only this very large production decrease would be compensated by larger production in Argentina, larger production in Australia, a very large production in Russia, and also a burdensome corn production in the world. That were all the expectations from the market. But in fact, we will see very quickly that this didn't happen. So back in June, the market became pretty bearish despite the lower production in Europe. So first of all, since more or less June, July, La Nina, which is a weather pattern around the globe, developed very strongly. And one of the major impacts of La Nina in the world is for dry conditions in South America and wetter conditions in Australia. So that was very favorable for Australia, but very negative for the Argentinian production. And quite soon in the year, during the summer, we realized that Argentina would produce 6 million tons less than what we expected, which takes the Argentinian exports not to zero, but close to zero. So what we thought would compensate the poor European production was pretty affected. And the second major story was what happened in Ukraine. Ukraine is also a very interesting school case, I would say. All the market was expecting back in August during the flowering season that the Ukraine, which is the first non-GMO exporter in the world, non-GMO corn exporter in the world, was going to produce 39 million tons, and only 2 to 3 months later, because of a very dry summer and during the flowering season, the production went down 11 million tons, and the export surplus went down from 33 million tons to just 22 million tons today. So this is absolutely huge, considering that, once again, Ukraine is the #1 provider of non-GMO corn in the world. And as you know, Europe imports only non-GMO corn, and Europe needs to import every year up to 22 to 25 million tons. This year, we reckon it will be 22 million tons. So about half of the European market needs just disappeared in 2 or 3 months. Considering that out of these 22 million tons export surplus for Ukraine, China has bought at least 4 to 5 million tons. So that leaves maybe 15 million tons or less for the European markets. So this has led to a very buoyant situation, and quite immediately in September, the corn market began to increase. So what we were expecting in July, the corn to compensate for the UK or for the European wheat deficit, just didn't happen. So on top of that, so on the supply side, we had a pretty surprising and very fast changing situation, and simultaneously, we had another surprise in the market, which is a Chinese demand for corn, especially for US corn, but not only for US corn, also for European wheat, for European barley. Chinese began to buy much more than any traders would have expected. So that really surprised the market. So these graphs can be read pretty easily. I mean, the red dots are the 5 years average US exports for corn, and the yellow line is what is the current situation. And as you can see, we are far above what the US usually exports. So what is happening in China? I will develop that afterwards, but this is another graph to illustrate the massive corn imports. You can see here that in average, I would say in the past 10 years, the US has exported around 5 million tons per year into China, and this year only, for the moment, they have exported 24 million tons, so more than 5 times what they usually do. So this came really much as a surprise. It is now more or less understood, but this came really as a surprise and has absolutely changed the stock, the ending stocks level. So what happened in China? So these two photos illustrate pretty well what's happening. But about 3 years ago, the pig industry in China was very, I would say, artisanal. Millions of farmers were producing 3, 4, 5, 10, 20 pigs in their courtyard, giving them all the food garbage, etc., etc. And then we had the pig fever, and the government decided to stop and prohibit the small pig units and transform them into massive units. And these units that you can see here, that they are like car parks producing millions of pigs. Only one unit like that can consume up to 12 Panamaxes of corn per month. So this is a massive change. Not only they are producing much more pigs, but also they now need to give them proper food. Proper food is soya meal, corn, etc., etc. So this is a massive change. This has led, on this graph, the Chinese domestic price to surge drastically. So if you look at this line on below, this is the international corn market delivered into China, and this blue line is the domestic price in China. So as you can see, today, the corn market in China is around $200 above the world market. So you don't need a lot of analysis to understand why 2 weeks ago China has bought 6 million tons of US corn in just 2 or 3 days, and that they will certainly, once their new year has ended, they will certainly keep on buying more corn in the coming months, because this spread allows massive imports and can only be explained by a massive shortage of feed needs. Another reason for prices to have increased is the export restriction that we've seen, and we had not seen export restriction for around 10 years. And this year, they came back on the front scene. So we had three countries who decided to enter into restricting their exports: Russia, Ukraine, and Argentina. And at the end of the day, only Russia really implemented them. But quite surprisingly for I would say, for traders, it did not have an impact, or at least not a major impact in prices. If you remember well, in 2009, 2010, when there were some quotas or export restriction in Russia, the wheat price nearly doubled. And this year, I would say that nearly nothing happened. And the difference between 2009 and this year is that the export restrictions are not linked to a shortage of volume in these countries. It's not because they don't have wheat or don't have corn that they decided to restrict their exports. The only reason is food inflation. So they wanted to, in this country, the price of food, the price of bread, the price of cigarettes, of vodka, or whatever, is highly important and is a political matter. So because world prices were going up, and at the same time, because of COVID and some other reasons, their local currency was devaluating, the combination of the two made the domestic prices pretty unaffordable for the domestic market and for the people, etc., etc. So this decided to cut it. but not stop it. So they just put some export taxes, which will, of course, harm the ex-farm prices. But we consider at this stage that they will not, at least not in a big manner, they will not change drastically the export flows. So, as you can see here, Russia produced this year 86 million tons, which is a record level, similar to 2017. So they don't have any problems, stock problems or availability problems in Russia. It's just once again a food inflation issue. But there is a more, I would say, there is more of an issue for next crop. So I won't have a lot of time here to develop it, but Russia has had the driest drilling season for the last 25 years in the southern district of Russia, which has led to some areas not being drilled, and will certainly lead to lower yields. And certainly also more vulnerability to winter kills. So we will see later, certainly in March or April, what is the extent of the damages on the Russian crop. But we already have downgraded the next year's Russian production to 76 million tons. So this is not really dramatic, because not only they will end certainly the year with high stocks, and 76 million tons will still, if they manage to get it, will still allow them to export next year. We will see, but it's clearly something to be watched for. But as I said before the export restrictions, we had a 40 million tons export target for Russia, and since they implemented the export taxes, because we know farmers will be slower to sell, etc., we've only downgraded our export target to 37 to 38 million tons. So it's only, I would say, only 2 to 3 million tons less export capacity for Russia. So this is not a major game changer. Once again, the major game changers are much more correlated to the corn and the soya market we've seen before. So as there were questions on barley coming from quite a few farmers, I've made two slides on the barley situation too. So the barley situation has different stories. In the UK, as you might all know, there has been this year a massive surplus of feed barley in the country, with around 1.5 to 1.6 million tons to be exported. With, as you might know, the UK does not have access to the big international tenders. We do not sell, or very rarely sell, to Saudi Arabia, to Tunisia, etc., etc. So our main market, about 80% of our exports, is Europe. And with the Brexit negotiation and the very large surplus we had, it was very difficult not only to be able to project ourselves into January onwards for the market, but also when you export to the European market, you export into very small vessels. You don't export with Panamaxes like we do from France or from other countries. So this has led to a very burdensome situation in the UK from harvest till December, with a spread to feed wheat going down up to minus 50 pounds per ton. And this spread, as we can see here on this graph, this spread, this is a different spread, but the spread between the UK market and the French market here in yellow, since more or less 1st of Jan, has narrowed from being about minus $50 to around minus $20 now, which means that because Brexit has been now confirmed soft, and we still have access to the European market, it allows the UK market to, let's say, recorrelate to the European market. So that's one story. the discount that was linked to the uncertainty of Brexit has narrowed and came back now to a normal level, which is -20, which allows the UK market to be exported into the UK. So we expect this spread to remain now, to be back to normal level. I would say -40, -35, -30 to feed wheat. The second story is in France, and for the first time in years, we also felt the consequence of the very strong Chinese appetite, and we can see it here. I mean, the feed demand in 2020-21 from China really surged. We are now at 50 million tons, where we were at 20 million tons in average in the past few years, and a lot because China does not buy anymore Australian barley. A lot of this demand has been provided by the French market, and not only on the old crop, but on the new crop too. So when the UK feed barley was depressed in the UK, we had an opposite situation in France, where the basis and the premiums for feed barley are at record level currently in France. I can already tell you that the new crop prices for barley in France, for feed barley, are trading at parity or even a small premium to milling wheat prices. And this is purely due to the Chinese demand. So France supplies China, which means very high demand, which is a very unusual demand, very high prices in France. And slowly but surely, this should spread into the UK market. So our view is that the discount to feed wheat in the UK and the spread to France should narrow, and this should lead to higher prices for feed barley in the UK. The only reason why it takes time for the UK barley to catch up is just because the UK market is not structured to access the international market. So maybe after Brexit it will happen, but you don't have the port facilities, you don't have the traders' knowledge, you don't have the agreements with China, Saudi Arabia, you don't produce the adequate quality, or you don't harvest with the adequate moisture, etc., etc. But if you get organized, if let's say the farming industry in the UK gets organized, you should soon be able to access this market. But for the moment, you are a coastal market going to Spain, going to France, and this is taking time. This is why it is taking time for the UK barley market to catch up with the world prices. A quick word on oilseeds too. So as I mentioned before, the oilseeds market are buoyant, and similarly to the first graph I showed you, the three components of the oilseed market's ending stocks are going down simultaneously. So this is clearly a bullish element for the oilseeds, with a very strong focus, of course, on the soya situation. But if we consider the 5 major oilseed crops, which are number 1, palm oil, number 2, soya, number 3, rapeseed, then sunflower, all these crops are tightening for different reasons. I will maybe develop that afterwards, but they're all tightening at the same time. And because the sub-products of the oilseed products like oil and meal are also going up very strongly, despite very strong seed prices, the crush margins are still very high, which allows your buyers, the crushers, to increase very strongly their buying bids. So on this graph, we can see that the palm oil prices after the COVID situation, when it drastically went down, since then nearly doubled. So the palm oil situation, where we thought at the beginning that because palm oil is very much used also into the energy sector, the market has priced because of the economical breakdown and the lack of demand for biofuel, etc. The market started to price the COVID as very bearish. But since then, because palm oil production needs a lot of labor, and in Malaysia there was a lot of imported labors from outside the country, they seem to have a major shortage of hands to work, a bit like some farmers in the UK who cannot get some Polish laborers or other laborers to take out their black grass from the wheat fields. So Malaysia has great difficulties to produce adequate production. So the production is going down, and as palm oil is the largest vegetable oil producer in the provider in the world, prices are very logically going up. So this is clearly a lack of supply situation. Same for soybean oil, and all that has been led also by much stronger energy prices. We've seen the crude oil now being back or even above the pre-COVID situation, which is also supportive for our prices. But as I said before, the major situation is soya. So what happened on the soya market? So we've already seen the US market, very tight stocks. Only the ending stocks only represent 2 weeks of imports from China. So now let's look at the Brazilian and Argentinian situations. So as I've mentioned, we've had a La Nina pattern this year. So La Nina has led to very dry conditions during drillings back in September, October last year. And this has led to delays in the drillings of soya, which is not very dramatic for the soya yields. But it is problematic for the second corn planting called the safrinha. So I explain you later why it is so problematic. But this slide represents today's situation, because La Nina has now ended. We have the opposite situation. We have too much rain going on now on the major production state of Brazil called Mato Grosso. It's in this area. So as you can see, there has been up to 30 centimeters of rain in the past 2 weeks, just during harvest. So as such, the Brazilian harvest, is about 3 to 4 weeks delayed now, and they've harvested about half of where they were last year. And this has a major consequence on what we call the safrinha. And the safrinha is the second corn crop in Brazil that represents 60% of the corn production in Brazil. This is planted after the soya. And because the soya harvest is late, so is the Brazilian safrinha, adding risk to not only the area, but to the potential yields in this crop. But the major consequence, and if you look today at the soya prices in Chicago, you would see that it is massively up, that it has touched again a record level, and this is due to this graph. So this graph is absolutely impossible for you to understand or to even to read. So this is not the objective, but this graph represents what the way the export market is structured in the world. So just to explain, during 6 months of the year, China buys the soybeans from the US. So until from September till February, more or less. And normally, as from February, Brazil takes the lead on the US to feed China. So that's the situation. The problem this year is because there has been a delayed planting and now a very delayed harvest, the switch between the US providing the soya to China, so the switch that should take, so Brazil should take the lead on the US for the export, is at least a month's delay. So this switch should only take place now in March, and maybe late in March, because the harvest, once again, is very delayed. The logistics, because all the logistics are made in trucks, the logistics are very slow. So as such, there might be up to 1.5 months delay in this switch. And as I've shown you before, there is only 2 weeks ending stocks in the US. So during 1.5 months, it's now very possible that China will not be able to buy any soya. And China doesn't hold any soya stocks. They just need it on like a malting barley industry. You know, they just need the flow to come into the country days after days, weeks after weeks, etc. So that explains why, at least during the coming 4 to 5 weeks, we might face a very explosive oilseed market and also a corn market, because they are very correlated. And if the corn market explodes, so will the wheat. So the situation today is that we have, and that has, I mean, I'm 48 years old. I have never seen that. There are about 270 Panamax vessels waiting in Brazilian ports, waiting to load without any soya to be loaded for now. About 15% of the soya harvest has been harvested up to today versus 31% last year. And the weather forecast is for some more rain until the beginning of March. And same for the corn, only 24% planted when we were at 51% last year. So this is clearly adding some risk to an already very tight situation. So this is clearly buoyant, at least on the short term, for the markets. Last but not least, on the world markets, to highlight how supportive they are, this is the freight rates, and this is very, very important for your UK prices, for the French prices, etc. Because I mean, the world, I call it, the world is a village. I mean, when you have a deficit, like in the UK, for instance, of wheat, you take it from Ukraine, you take it from Russia, you take it from France, etc. So the higher the transport, the ocean transport cost is, the higher it costs to take it into the UK. So if you want to take some corn from Brazil, for example, it will today cost you twice more expensive than 6 months ago, because the freight rates went up. So this is a very supportive element for domestic prices. And it is also a very strong illustration of how strong is the international demand. So both, it is supportive prices, and secondly, it shows how tight and how strong the international demand is. So this is, again, a very supportive element. Well, I didn't mention here, because we don't have enough time, but the European situation. But Europe is clearly, on the physical market, going to face a very, very tight second half of the season. And the end of this season should be also very, very tight in terms of wheat, because the exports, the wheat exports have been far too strong when compared to the supplies. And the corn imports so far have been far too slow. So all the physical brokers I talked to in France are all telling me that the situation is really problematic. So some of them are really starting to be very stressed about the situation. So we might have a second part of the season very, very tight. I will stop here, Gary, to make a pause if there are some questions, and I will move on afterwards onto what we can expect.
Thank you. I will consolidate some of these questions, and I will also put 3 questions to you at this stage. First of all, consolidating some of those points, Sébastien, given the facts highlighted, namely low stocks, production issues, large demand, and the high prices that you've illustrated, do you believe that the market still has more potential to increase?
The question is clearly yes. I mean, looking at past history, yes, there is more room. Looking at UK at £200 seems to be a very, very high level. But if we take into consideration the currency impact and the importing nation impact, in fact, the price, if we compare it to back to 2009, 2011, when the prices went above £200 also in the UK, in fact, the £200, it's a much internationally, or in dollar terms, it's a much lower level than it was before. So yes, indeed, there is more potential. But for that to happen, we will need some of the current weather threats that I'm going to drive you through after that. We'll need some further fuel, I would say, to the current situation. But clearly, we are facing a very tight situation in the world. Okay, this is a fact. So in a tight situation, any additional risk on the supply or any additional demand from the Chinese side would clearly tighten even more the situation. And the only way the market can address a tight situation is prices to climb to ration the demand. That's the only way. So I wouldn't say that sky is the limit, but if indeed Chinese appetite keeps on growing, and if we do face some further issues in Russia, in Brazil, or in the US during the drillings, yes, indeed, the prices will certainly go much further up.
Thank you, Sébastien. I have two questions regarding China. The first one from Ali. Will China consume more feed barley and soya going into the future?
Yeah, the answer is clearly yes. Feed barley, soya, corn. So it's not only a question of, I mean, this year they clearly had a weather issue. So they also had a production issue. They've had 3 consecutive typhoons in March and April, which has led to a poor wheat and corn crop. So this has, let's say, increased their needs. Secondly, as you might know, China is holding half of the wheat stocks in the world. They're also holding huge quantities of corn. But China considers these stocks as purely strategic. Okay, they don't want to be dependent of the rest of the world. So, like we have a nuclear bomb, like we have things like that, they consider their stocks as strategic. So they will not eat into their stocks if they have a deficit or if they have more demand from the feed industry, from their people eating more, etc., etc. They will buy it from outside. So we are now, well, I don't have the graphs here, but we are now at 100 million tons of soya imports. This can only keep on increasing. The corn should continue, as I showed you, because very logically, just because of the price spread. So very logically, there is no way China could decrease their appetite.
Thank you, Sébastien. Another geopolitical question regarding China from Jonathan. How permanent is the Chinese ban on Australian barley?
I don't have a clue. They are, I mean, it will certainly depend also on how Mr. Biden deals with China. He seems to be walking in the same direction as Mr. Trump, willing to prolong the commercial war with China. So, frankly speaking, I don't know. This is diplomatic issues. So it's ongoing, and well, I don't really have the answer to this question, sadly. These are part of what we cannot forecast.
Yes, indeed. Sebastian, if you would like to continue with the rest of your paper, please.
Yeah. So as I said, as I showed, we do face a very tight situation, very low stocks, surprisingly very high demand, especially from China. So this is only supportive for our markets. And one of your questions was, do we have more fuel for prices to go higher? I would say it will very much depend now on the new crop prospects, because we are now in February, nearly in March. So very soon prices will start moving, only looking at the new crop fundamentals rather than the old crop fundamentals. The old crop fundamentals, they are known, they are tight. So now it will very much depend on how the supply and the demand side also, but the supply could untie this situation, or if it brings more, if it doesn't. So it will be very much correlated to the weather on one side, and most certainly also on China. So let's look at the weather. So in Europe, I would say that at least in Western Europe, I would say that everything is more or less fine, with a few issues. UK is one issue. I mean, we know that the production will not be record, but looking in more major countries than UK in terms of wheat, we've had a cold wave last week, and the south of Germany, we can see it here, didn't have any snow cover, with a very with up to -16, -20 degrees. So there might be a wheat and rapeseed production issue here in Germany. Our clients in Poland are also reporting some issues on the rapeseed and part of the wheat in South Poland and northeast of Poland. But other than that, there is absolutely no major issues to be highlighted for the moment in Europe. And the weather for the last, let's say, 2 weeks has been much drier and much warmer, which should lead to much better conditions for the spring. There seemed to be a little bit of worry at the moment in south of Russia, and northeast of Ukraine. Northeast of Ukraine has positive temperatures at the moment, and a new cold snap is forecasted for the next week. South of Russia doesn't have any snow cover, so we do have, and we do highlight a risk here with potentially very low temperatures and very little snow cover for the coming weeks. So this is currently a source of concern for the market. So the next 2 weeks will be very important here. We've got a situation in the US too, with a record low temperatures on the winter wheat, which is the hard wheat, which is very important to the UK market, because the UK imports quite a lot of hard wheat from Canada and the US. So this in Kansas, Oklahoma, etc., they did face a very cold, up to -30 degrees in the wheat plains, with very little snow cover reported. Sadly, we will only know the results or the winter kills only in let's say 3 or 4 weeks time. So it's maybe too early to say, but this might also lead to higher prices in the wheat market. And as you can see on the right graph, the crop conditions are pretty poor or lower than the 5 years average. So there is clearly a situation here. Speaking about weather market, we will certainly enter into a very traditional weather market in March during the spring drillings. So in these areas, it will be highly important to look at the market. Last but not least, in South America, as I said, La Nina is now over, and we will now look for drier conditions, hopefully, on Brazil during the corn drillings and the soya harvest. This is not about to happen because we should have another 2 weeks of rains, but this clearly is one of the weather markets that has to be very well monitored in the coming weeks. So let's move at the conclusion to the strategies. So the conclusion is, what can we expect and what strategies can we put in place in front of this volatile market? So talking about UK market or UK correlated prices, I would say that there is two elements to watch for very closely for the UK market. One is, of course, currency. So in ODA, we believe the currency, the sterling could keep on strengthening in the coming months. We believe the 0.85 level should be achieved very soon. And if the vaccines campaign keep on working well and you deconfine quickly, we believe we could go up to 0.80, which would have an impact of about 6 to 7% negatively on our UK prices. So we would consider the UK, the currency, as a bearish tone to the UK market. The second element we will watch for very closely, and we will start to have an answer by the end of March, is the UK going to be a net importer or a net exporter next year? And that will have a positive or negative impact on current new crop prices by around 10 quid. So if we are a net exporter, our price will move from where they are now to, let's say, 160. If we are a net importer, we could move to 180. We will watch for, and we'll work very hard to be able to forecast the UK production. But the most important for us is clearly the world prices. And for the moment, until at least the end of March, we consider all the fundamentals we receive and we analyze as being bullish. So with the situation we have now, we consider for UK farmers that there is absolutely no interest to sell on the short term, and that we will review the situation sometimes, I would say, by the end of March or beginning of April, once we know better about the UK situation, once we know better about the US drillings, if they went on well or not, and once the soya and corn situation, the squeeze we have in the market actually in Brazil, will have been solved. So very short term, we are bullish to very bullish from where we are now. On the longer term, which is, let's say, in 3 months' time, it will very much depend on, I would say, on mainly on the US crop, because we are expecting record acreage of corn and soya. We are expecting record yields because with current prices, US farmers would certainly invest very much into their crops and their yields. So we consider the trigger to take decisions will happen between, let's say, end of March and end of April. Certainly, we'll be able to act on that. We have two different strategies inside ODA. One is for about 40% of our farmers who do hold a futures account. For them, because we wanted to hedge the currency risk, we did sell the new crop wheat, but we re-exposed it, and that was before December, to the world market. So we sold the physical wheat in the UK, and we bought some corn on Chicago because we consider the corn as being the leaders, the market leader, and we did well because of course the corn went up very much. For the farmers who do not hold futures account, our advice is clearly for barley, for oilseed rape, and for wheat is to hold until at least mid-March or end of March. We should see higher prices, and by that time we will know if it's an opportunity to sell or if we should hold on if the risk have materialized. Sorry. If we have a bit of time, I have highlighted here what are the elements we will have to look for in the very short term. So as I said, in the US, we will watch for the US spring drillings with the associated weather market. We will watch for the US winter crop condition that has seen some very cold temperatures, and sometimes in March, April, we will get the feedback from farmers on whether they were very impacted or not. And of course, every week we will watch for the US exports and with a focus on the Chinese demand. In China, as I said before, considering the very strong spread between the Chinese domestic prices and the world market, we consider at this stage that China will continue to buy massive quantities. So soya, it's not questionable, but we're talking here about barley and corn and wheat. So we consider China will remain in 2021 a major actor and a major supportive element for the world market. Russia raises more questions than answers for the moment. So how the export restrictions going to impact the farmers' behavior? Is Russia going to be able to keep on exporting massive volume? This is a question that will be monitored here again every week when we'll get the exports figures. We have a big question mark also on their capacity to produce 76 million tons. Will it be less? We don't believe it will be more, but here we've got also a real question, and it will depend on the spring conditions, on the winter kilns too. So this is clearly an ongoing risk. And we've just talked about it, but South America is clearly focusing also on attention, especially on the short term, with big logistics problem, huge queues in the ports, and a very delayed supplies coming from the fields. So all this combined is clearly supportive, with some question marks that will be answered sometimes between March and April. And if we look only at the UK situation, is the scenario we have on the table for now is a sterling strength, which is negative for our prices. A big question on wheat being an importing or an exporting nation. Maybe it will be neutral and it will stay where we are, but this is a very important factor, about 10 quid or 15 quid on your prices. And of course, we will watch for the spring conditions that will be key when we remember last year's. So it's sum up here on the last sentence is, for the moment, for the farmers who listen to us, we would advise to wait at least a month and a half, and we'll be able to take decision with very little downside potential for the moment. Very little downside potential for the moment. So no risk. And that's it for me, Gary.
Thank you, Sébastien. Appreciate that. Sébastien, we've probably got about 10 minutes left. We have some questions that we will try to address immediately. I'll put one through to you, first of all, from John P. How can I protect my feed barley price when making a malting barley contract in February? If the tonnage fails its quality, so that I know I've secured a better forward price rather than the normal low feed barley price at harvest time.
Okay, I've just had a similar question from a client today, and my advice was not to sell. So, the feed barley price is at 150, let's say in November, and 140 out of the combine for the new crop. We consider for two reasons. First of all, we are bullish world market, so we consider it's not a good timing to sell. And secondly, maybe I wasn't very clear, but secondly, we consider the French market as being a buoyant market, okay, with very strong prices for the new crop, and we consider it will spread, not immediately, but it is spreading now into the UK market. Okay, traders are all aware of this situation, farmers are not. So of course, traders are trying to take advantage of this situation because they have the information. They can buy a cheaper barley in the UK when to provide it to the French or the Spanish at a much higher prices. So it will spread into the UK, but slower. So for me, it's not at all a good timing to sell barley in the UK. And now, to secure a feed barley price when you want to sell a malting barley quality, you can have a non-defaultable contract with a floating or a fixed malting barley premium, and this is quite largely available in the market. So I would say to this farmer, either you give us a call or otherwise ask your buyers, and they should be able to provide you such a contract.
Thanks,
but I would wait 1 more month.
There was a different question from a different channel here. The question was, what's the best way to get into the futures market?
Alors, futures market for UK farmers is now, I would say, close to impossible. I mean, the only way you can achieve that is if you provide a minimum deposit of £100,000, which is, to our point of view, prohibitive for farmers. So in ODA and for our clients, we found a solution in the US where they are less restrictive to farmers or to retailers. So we do provide for our clients solutions with brokers in the US to access live, MATIF, currency markets, and all international platforms for very and much lower commissions than what the UK brokers do. So it was possible and easy until about 1 or 2 years ago. And for the last 1 or 2 years, the UK brokers have decided they didn't want to work with farmers because, of course, farmers do not trade large volumes and they consider them as not profitable. So there are some solutions, and we would be very happy to provide these solutions to this farmer.
Thank you, Sébastien. We are running out of time, so there will be one last question, one a little more fundamental, I believe. Charles B, some say if you sell your grain in the same month all through your farm career, you may do as well as trying to forecast the market. Your thoughts?
Yeah, an average price. Why not? So I think this is a statement. I would say that this is a decision that any farmer can take, and that will allow him not to worry about the market, that will allow him not to spend any time on the market and just sell blindly every day or every month. And you have some financial products that allows you to have an average price, etc., etc. So why not? I would say that if I was a farmer myself, I would consider, because it is a fact, that 50% of your profitability is linked to price and 50% is linked to yields. So as a farmer, you tend to spend 80-90% of your time working on your agronomy, on your yields, etc., which is very important, and you tend to spend very little time on the markets. So the answer to this question is, of course, when you spend time on your markets, when you take some informed decision, when you train to understand what you do, of course you get some results. I mean, ask the Brazilian farmer, ask the Argentinian farmer, ask the US farmer. I'm choosing these examples because these farmers have been using risk management techniques for now decades, and they are all very happy about that. So it is I wouldn't say it's a full-time job, but if you spend some time on that, not only you will lower your risk, you will understand what you do. And I can tell you from the historical data that is public in ODA, that for the last 20 years we've been here, we've always beaten the average price. And our average wheat price, when compared to the average price, is plus 14 quid. So taking 20 years, we are always selling 14 quid above the average. Which doesn't mean we sell at the highs, because this is not our objectives, but we always beat the average. So when you spend a bit of energy and you invest a bit of money or whatever in this, in the market knowledge or market information and market analysis and market advice, you will get a reward. And very statistically, it's 14 quid per ton above average price if you follow to the letter the ODA advises.
Thank you, Sebastian. We are now quietly, ladies and gentlemen, quietly coming towards a close of the session. Thank you, Sebastian, for your paper. Much appreciated. Ladies and gentlemen, thank you very much for your attendance and the questions that you have raised here today. Please note this webinar will be made available to you upon demand and will be emailed to you after this meeting. If you look to the bottom of the screen, you will see resources, and here you'll find links to 2 ODA Weekly publications. I'm sure you'll find them interesting. For attendees to the webinar, we will provide you with 1 month free access to ODA Weekly. Please email me direct and I will arrange this for you. We also have provided a link to the ODA website. Please register, and this will provide access to the contents of the website, including futures markets and foreign exchange. Furthermore, an opportunity via the link to participate in the ODA crop survey. This will be a situation where we will determine, using this format, will the UK be an exporter or importer for new crop? Finally, please feel free to contact us directly so we can address any additional questions. Our contact details are in our biographies in your registration and for this webinar and on our website. Thank you. We look forward to hearing from you. Enjoy your evening.